Welcome to week 14, everybody. We are in the home stretch near the end of our course. We have 2 weeks left after this one, as I'm sure you know. And today we are, of course, going to go through the chapter 14 material. Before we do, let's see, I guess it's been about a week since I posted this, so I don't know that I covered this last week. But if you're interested in internship opportunities here at Hartnell, there are some paid internships and some not paid. You can click on the link in this internship opportunities announcement. And if you're just interested in information for your career in general, for example, we have a great job speaker job board you can access through Duo, but you can also access it through the Career Hub. We have great webinars and recorded videos about how to advance in your career, how to find jobs, how to interview. There's Belen, she's the director of the Career Center. She can help you put together a resume. So many great resources we have for people looking for career advancement. You can click on Career Hub for more information, or again, click on Job Speaker through Duo, through the Duo app, and get some assistance. Okay, so there's a lot available to you. Another thing I wanted to mention, some of you have completed this already. I am running a poll to find out what of the different course activities you feel are most effective in helping you learn. So when you click on this link under the announcement, quick poll about how you learn best, you click on the link and it brings up this page, and just select from the drop down which is you think the best activity in this course to help you learn, and then another window will open up. You can select the second best, the third best, all the way down to the 8th, which would be the least helpful way for you to learn. And it'll be interesting to know what you all think. I don't get your individual responses, but I do see the collective responses of the group, and it helps me fine-tune the class and improve it. Which just reminds me of something. I'm just going to make myself a note, something I need to fix, not in this poll, but in a poll I did for a different class. So I will fix that later. Okay. I think that's it for my announcements. Last week I went over the course project and what the expectations are for that. If you missed it, go back and watch that video. It was part of the lab recording for last week. I think it was at the end of the recording, or maybe it was the beginning. I'm pretty sure I did it at the end. But anyways, check it out. If you have questions on the course project, let me know. If you haven't started working on it, start working on it, because it does take a while to find all the data and do your analysis. Filling out the presentation file is probably the easiest part because you don't have to write that much, but you do need to do the research before you know what to put in your presentation file. So get started on that. There is a template for the presentation. You're not actually going to present it. You're just going to create the file and upload it. You can download that template with this little arrow next to where it says template you can use here on the financial analysis course project page. You can access this page through the course project module. It's the second link in that module. And you can also find it under, I think it's chapter 15. Yes, because it is due on May 14th. So that is a week from this coming Sunday. All right, so go ahead and get working on that if you haven't already. If you have any questions or need any help, let me know. You do need to pick a publicly traded corporation. So I'll be glad to assist you in figuring out whether a particular company is publicly traded if you're not sure. Okay, so I think that is it. We can get into our chapter material. This week we're learning about corporation accounting. And basically that means we're going to be learning about how to journalize stock transactions. For example, when a company issues stock or they buy back their stock. That's mostly what we'll learn. We'll learn about earnings per share, one of the common financial ratios that investors look at in deciding whether or not to buy a stock. So let's just go ahead and start going through it. We have 21 exercises, which is quite a bit, but they go pretty quickly. We also are going to go through, I think, 4 problems together. So I'm not sure how long this is going to take, but let's just see how it goes. Okay, so from exercise 1, it says we are doing accounting for a company that recently decided to incorporate. They had attorney's fees, promotion costs, and filing fees, all related to the process of incorporating. And they totaled $4,300. Well, this is pretty easy. That gets journalized as organization costs expense. So we just debit 4,300 and we credit cash. So all of those activities related to setting up the corporation get journalized at the same time. I guess if they happen in multiple periods, you might do it multiple times, but it's all under the account organization costs expense. Okay, number 2. What is the impact on stockholders' equity when a company uses debt financing as a source of funding? It's a trick question. There is no direct impact on equity when a company uses debt financing. Because what happens if a company either takes out a loan or issues a bond, their assets go up because they got the money from the loan or the bond. Their liabilities go up because they have to pay the debt back, and equity stays the same. So there is no direct impact. You could argue that there's an indirect impact, but we don't need to get into that level of detail. So we'll just leave it at that. What is the most obvious difference between debt and equity financing? So for exercise 3, we will say debt financing must be repaid with interest. Equity financing dilutes ownership of the corporation. Okay. So when you issue stock, you do not have to repay those investors. Basically, they gave that money to you in exchange for ownership in the company, and that's it. You never have to repay them. You could buy the stock back if they were willing to sell it and you wanted to, but there's no obligation to either party that they do that. When you do that, that's called treasury stock, and we'll be learning about that a little bit later. Also, when you issue stock, you are giving up some ownership of the company, and that means that when you pay dividends, there are more shares of stock to spread those dividends across. It also means when there's a vote that the stockholders get to vote on, they have more power, right? The more shares of stock there are out there, the more voting power you have given out, right? And at some point, it might be enough to actually influence who's on the board of directors. If one investor owns enough stock, or if they can get together with enough other stockholders and all vote the same way, they get to decide who's on the board of directors. So that's something to keep in mind, because then who is in the board of directors gets to hire or fire the executives, decide when to issue dividends, and so on, set the strategy of the company. So if you don't want that to happen, then avoid over diluting your stock. Number 4, how do creditors assess risk when lending funds to a company? Well, there are a lot of ways you could answer this question. They look at the company's track record, the character of the owner, the management team, the business plan. But the short answer that the textbook is leading us towards here is liquidity and solvency ratios. These are the types of financial ratios that look at the ability of the company to pay off its debts in the short term, which would be the liquidity part, or just overall, which would be the solvency part. So those ratios would be key in whether or not a lender would lend money to the company. Okay. Number 5, here we are going to actually do some journal entries. We will do quite a few journal entries like exercise number 5. So I'll walk us through it step by step. Okay, so this company was authorized to issue 1 million shares of $1 par value common stock. Well, the two types of stock that we will be dealing with are common stock, where the stockholders do get to vote, and preferred stock, where the stockholders do not get to vote, but they're more likely to get some dividends. Okay. Now, stock usually has a par value or sometimes a stated value, but we treat them both the same, whether it's a par value or stated value. And that is an amount that is used for the bookkeeping, for the account records. It's how we record the value of the stock that has been issued by the par value or the stated value. So in this case, this company has said that their stock has a $1 par value. So every share of common stock on the books shows a value of $1. Now in the market, the stock might be worth more or less than that. So the par value is really just for bookkeeping. Okay. I think that's all I should say at this point. Let's go ahead and solve this exercise. So for the January 31st transaction, the company issued 40,000 shares at $10 a share. That is the market price that the stock was sold for. Okay. And so if we take 40,000 shares times $10 each, that's $400,000 of cash that the company received. And they gave out the 40,000 shares. Now the par value was $1 per share. So we take 40,000 shares times $1, and that's $40,000 of common stock that the company has issued. Now the difference between what the company received and the par value of the stock is $360,000 in this case. And we call that, ooh, that's not what I meant to do. Sorry. That's what I meant to do. We call that additional paid in capital from common stock. Okay, that's the extra money that was received from issuing that stock above the par value. On June 10th, the company issues 100,000 shares. And they do that because an investor gave them a building worth $850,000. The company now has, land. It was land. The company now has land worth $850,000. They gave out 100,000 shares of stock. We multiply that by the $1 par value, and that's $100,000 worth of common stock. And then the difference, again, is additional paid-in capital from common stock. So if a company receives property and agrees to give stock in exchange, then we treat it just like we would with cash that's coming in from an investor. Obviously, we journalize it as whatever type of property it is, but the rest of the transaction is the same. So we got $850,000 worth of land We issued $100,000 worth of stock based on the par value. And the difference, which was based on the market value, is additional paid-in capital. So additional capital we got from the investors that they paid in for the stock above the par value. Okay. Then the company bought back 10,000 shares of stock. When they do that, it's called treasury stock, and they paid $9 a share. So 10,000 shares of $9 each is $90,000 of treasury stock and $90,000 of cash that they had to pay. The last part of this question is how many shares of stock are outstanding? Okay, so let's talk about that. It says up here that the company is authorized to issue 1 million shares. That means the state in which the company incorporated authorized that company to issue up to 1 million shares of stock. The company can do that whenever it wants. And so far they have issued 40,000 shares in exchange for cash, 100,000 shares in exchange for the land. So that's 140,000 shares. But then they bought back 10,000 shares. So 140,000 shares were issued. 10,000 were bought back and are now treasury shares. And then the difference, 130,000 shares, are outstanding. Those are the shares of stock that were issued and were not bought back. Okay? So to answer this question, how many shares of stock are outstanding? It's 130,000. Issued minus treasury stock equals outstanding stock. Again, number 6 is similar. This time, though, we are putting in the account names. So the company issued stock. They received cash in exchange. They issued common stock. And the amount that they received above the par value is additional paid-in capital from common stock. Okay. The July 9th transaction is the same, except instead of cash, they received a building. Otherwise, they had the par value, which is common stock, and the rest is additional paid-in capital. And then they bought some treasury stock. So they got treasury stock. Okay. And they had to pay cash. So that's what that journal entry looks like. All right, I was going to ask if there are any questions, but there's nobody logged into this call but me, so there's no point in asking, right? Unless I have any questions for myself. Okay, number 7. Same sort of thing. The company issues stock, 300,000 shares times $5 a share. They sold them for, that's 1,500,000. Then 300,000 shares times the $2 par value is 600,000. And the rest is additional paid-in capital. Then the company got some equipment worth $200,000, so 200,000. They issued 90,000 shares times the $2 par value equals 180,000. The difference is additional paid-in capital. And then the company buys 3,000 shares of stock, so that is treasury stock. And at $7 a share, that comes out to $21,000, and cash gets the credit. Okay. So hopefully you're starting to see the patterns here. In this situation, let's see. Okay, again, we have to fill in the account names. So The company got cash in exchange for stock. So I'm just going to paste in those same account names. In the June 15th transaction, they got office equipment. So let's go ahead and just make this office equipment. Oh, I should point out, in this case, it doesn't say par value, it says stated value. So some states do not require a par value, but the company might still come up with their own, and they call it then a stated value. And we treat it exactly like a par value. So when the company, let's see, they issued 5,000 shares at a $5 stated value, that came out to $25,000 of common stock. We subtract that from the office equipment, and the difference is additional paid-in capital. Okay, so that's how that works. And the last one, we bought some treasury stocks. So treasury stock gets a debit and cash gets a credit. Okay, moving on to number 9. Another similar one. So here, 140,000 common shares at $10 each. Okay, so that's 1,400,000. The stated value of the common stock is $1. So 140,000 shares times $1 is $140,000. The difference is our additional paid-in capital. Now for the land, notice they issued preferred shares in exchange for land. Here it says the preferred shares at a $5 par value. Okay, so they got $850,000 of land, issued 160,000 preferred shares at $5 each, which comes out to $800,000. And so the additional paid-in capital is $50,000. Then they issue 10,000 shares of common stock. So they get $90,000. That would be $10,000 of par, I'm sorry, stated value in this case, or was it par value? No, it was stated value. It was $1 stated value for each share of common stock, right? So we multiply that by the 10,000 shares. That gives us $10,000 of common stock. Subtract that from the 90,000 they received, and that's 80,000 additional paid-in capital. Okay? Moving on. All right, so enough of those sorts of journal entries. I hope you got the hang of it. When a board of directors of a corporation decides to take some of the profits of the company and pay them out as dividends to the investors, there are 3 dates involved. There is the date of declaration, when the board of directors declares that they are going to be issuing a dividend. There is the date of record. On the date of record, no journal entry is needed. But what's significant is on that date, whoever owns the stock is going to get the dividends. So if you buy some stock on the following day, after the date of record, you're not going to be getting dividends this time around, because even though they haven't been paid out yet, when they get paid out, it'll be based on who owned it on the date of record. Okay, so anyways. Then the third date is the date of payment, and that does get journalized. So what we're going to do here for exercises in 10 and 11 is we are going to journalize the initial declaration of the dividend and then the payment of the dividend. So the declaration, in this case, was $1 per common share. That was the dividend that was going to be paid out. Now, it's only paid out on the outstanding dividends, stock. The reason for that is the outstanding stock is all the stock that has been issued minus the treasury stock, and it wouldn't make sense to pay dividends on treasury stock because who owns the treasury stock? The corporation. So why should they pay dividends back to themselves, right? That doesn't make sense. So instead, they're only going to pay dividends to the stock that has been issued but has not been bought back, and that is what we call outstanding stock, right? So in this case, there were 12,000 shares that had been issued. 2,000 shares were treasury shares. So that means there are only 10,000 shares of outstanding stock. And it's $1 of dividend per share. So that's a total of $10,000 of dividends. That reduces retained earnings. So retained earnings gets a debit because it's the profit that the dividends are getting paid out of, right? That's what justifies giving this money to the stockholders, is that the company made a profit. And so the retained earnings decreases to pay for these dividends. If a company doesn't have any retained earnings, they probably shouldn't be paying dividends because that means they are not doing that well financially. Okay, and again, on the date of declaration, the company does not actually pay the dividends. They just declare that they're going to. So they have cash dividends payable. Okay, then the date of record comes by and they make a note of who owned the stock on that day, because those are the people that will get the dividends. And then when the date of payment comes around, in this case, it's about a month later after the date of declaration, but sometimes it's not quite that long. When the date of payment comes around, then they actually pay off the cash dividends payable. How did they do that? With cash, right? So that payable goes away with the debit and the cash reduces with the credit. Okay, we will learn later that you can pay out other forms of dividends. Actually, I don't remember if we have an exercise or a problem that deals with that. So in case we don't, it is possible to pay out dividends with property instead of cash. So if the company wants to give out free product or some other sort of property instead of cash dividends, they could do that. It's not that common, but it is an option. They can also pay out dividends by giving out more dividends. The investors don't actually gain any value. They just have more shares, but they still add up to the same total value. So whether that's really desirable for investors kind of depends on your perspective. It might help the stock price to go up because if there are more shares, that reduces the price of the stock, but it would also maybe reduce the earnings per share. So I don't know, you'd have to do a more thorough analysis, but it doesn't happen that often, but it is an option. You can pay out dividends with additional stock. All right, number 12. Here's another dividend scenario. This company has declared a dividend of $5,000. Okay, so they're going to pay out $5,000 in dividends. That's the total amount. Now there are 3,000 shares of $5 par value, 5% preferred stock. Okay, what that means is the owners of the preferred stock, when dividends get paid out, are entitled to 5% of the par value that they have in dividends. Okay, that's why preferred stockholders are more likely to get dividends, because they are entitled to that. If then there's anything left over after paying the preferred stockholders their 5%, then the common stockholders can get dividends. But if there's nothing left over, then the common stockholders don't get dividends. Now, that doesn't mean that the common stockholders are going to get less. In some cases, they might get more dividends, but they're just less likely to get dividends at all. And really, there's some companies that never pay dividends. So there's really no guarantee that any stockholder is ever going to get dividends. It just depends on how profitable the company is and whether they want to direct those profits back into the company to grow, or if they want to reward the investors and try to attract more investors by paying out dividends. Okay, so for this problem, the total amount of dividends that have been declared is $5,000. We have to figure out how much of that is going to the preferred stockholders. So we take the 3,000 shares of preferred stock that are outstanding times the $5 par value of that stock. So that's $15,000 total, times the 5% that these preferred stockholders are eligible for. And that comes out to $750. And you might be wondering, where does that 5% come from? It's just something that the company decided when they created that preferred stock, that they would offer a 5% dividend. Some companies do a cumulative dividend. So if they don't pay dividends in one period to the preferred stockholders, they will get double in the next period so that they catch up. So that's something to be aware of. But in this case, it's just one period. So we take the number of shares times the par value times whatever the percentage happens to be, in this case, 5%. Then we subtract that $750 of dividends that's going to the preferred stockholders from the $5,000 total dividend, and we get $4,250. So that is the amount that's going to the common stockholders. It'll get divided up among them. So however many shares are outstanding, you divide that 4,250 across all those shares. And that's how we do it. So I see Maria has joined us. Welcome, Maria. We are about to start exercise number 13 in the chapter 14 exercise set. Okay, now we get to small stock dividends. This is where a company is paying out dividends by giving more stock. If you are giving out less than 25% of your existing stock as a stock dividend, that is considered a small stock dividend. More than 25% is a large stock dividend. And the reason they're treated differently is a small stock dividend is not likely to impact the market price of the stock. However, if you're giving out more than 25%, that has a pretty big impact that could cause the value of the stock to shift in the marketplace. And so we treat that differently. In the chapter, you can find more information on that. Just to show you real quickly, let me pull up the PowerPoint, chapter 14, and find that in there. Let's see. That's property dividends. Okay, here we go. Small stock dividends. As it says, less than 25% of the outstanding shares being given out, that is called a small stock dividend. Here's how we're going to journalize it. And you can see here, this is also in the textbook. It shows the impact of the equity stockholders, equity section of the balance sheet. You'll see there is a small impact to that section. And for comparison with the large stock dividend, see that also has an impact, but it's a different impact because the way we handle that is different. Okay, so anyways, you can read up more on that, but for the exercise set, I think that's all we really need to know. We just need to journalize this transaction. So let me think. So when we do this, what we do is we are taking some of our retained earnings, just like if we were paying a cash dividend, and we're using those retained earnings to pay out more stock. Why is it 60,000? Well, there are 10,000 $1 par value shares of common stock with a market value of $30. Okay, so if we take $30 market value times the 10,000 shares, that's $300,000 of stock market value times the 20% we're paying out as a dividend. That's $60,000 worth of stock. Okay. Now, 20% of the 10,000 shares is just 2,000 shares of stock, right? So 10,000 shares times 20% is 2,000 shares of stock times a $1 par value is $2,000. So we are issuing $2,000 of common stock. And then just like before, the difference is additional paid-in capital. But in this case, it's from stock payable, I think. I'm going to double check this. I don't remember. No, that doesn't sound right. Okay, so that one. That's the declaration. Okay. What are we doing here? We declare, oh, this is the declaration. Okay. Okay, so this is how we do it. I was wrong. So it's common stock dividend distributable. And then additional paid-in capital from common stock. Okay, so that is the correct way to journalize it. Again, if you want to see, oh yeah, I can just pull it up here. Let's just do it that way. And see the official answer. Common stock dividend distributable 2,000. Additional paid-in capital common stock is the 58,000. Okay. Then we can go on to 14. This company has paid quarterly dividends. That's the most frequently a company would pay dividends, would be once per quarter. And again, it's up to the board of directors based on the quarterly profits, whether or not they want to pay dividends. So this company has paid quarterly dividends every quarter for 15 years. Well, that's great, because for those investors that own that stock, they're getting some dividends every 3 months, and they probably like that. Now, there are some investors that don't care about dividends. They're looking for companies that are growing quickly and not necessarily paying dividends. And their plan is to sell the stock at a higher price once it goes up because of the company's profitability. So you do have those investors that are just looking for capital gains. But investors that like the income provided by dividends, like that consistency that this company is providing. However, it says that this company has a cash crunch and sales have been slow. So while the company has positive retained earnings, it's close to zero. So they're running out of profits. So their previous profits, they've kind of used up, and they don't have a lot of new profits. So they're basically, not that profitable. The first question, should the company continue to pay dividends? I would say no. Now they might, they could, but the dividends are supposed to be a portion of your profits. If you're not making a profit and you're still paying out dividends, it's going to be harder and harder to catch up, and you might get into a situation where you have no cash to pay your suppliers and you have to file for bankruptcy. That would be bad, right? So I would say if you're not profitable, don't pay dividends. So that answers the second part. A company that is not profitable and pays dividends. Sorry, something is tickling my nose. And pays dividends, risks running out of money and possibly going bankrupt or even out of business. Some bankruptcies let you stay in business, but in some cases, you do a complete liquidation of the company and you have to shut down. Okay, so Maria, if any questions arise, let me know. Let's go on to exercise 15. This company started the year with a retained earnings balance of $20,000, okay? So those were profits that had carried over from previous years. They paid $3,000 in dividends, and remember that when you pay out dividends, that reduces your retained earnings. And they earned a net income of $60,000, which increases your retained earnings. So to figure out their ending retained earnings balance, we're going to take the $20,000 they started with, subtract the $3,000 in dividends, and then add the $60,000 in net income. And we get $77,000 as their ending retained earnings balance. Okay, so that's right, but I still want to check it. Number 16. This company started with a retained earnings balance of $50,000. They paid $5,000 in dividends, and they had a net loss of $25,000. Okay, so in this case, they started with $50,000, paid out $5,000 in dividends. Now we're down to $45,000, and then they lost $25,000 because they had a bad year. And that brings them down to retained earnings of $20,000. Okay. So that is it for 16. On to number 17. So this is the company's account balances at the end of the year. And the question is, what would be the ending balance reported on the company's statement of stockholders' equity? So we have to look at these accounts and see which of these impact the statement of stockholders' equity. Cash does not, because it's an asset. Common stock does. That is the contributed capital portion of the company's equity. Accounts receivable, that's an asset. Accounts payable is a liability. Additional paid-in capital is part of equity because, as we know, when we sell stock, the money that we get in addition to or over and above the par value is the additional paid-in capital, right? So that increases the equity of the company when that happens. Prepaid insurance is an asset, unearned revenue is a liability, retained earnings is equity, right? That is the portion of the equity from the company's previous profits. And really, those are the three numbers that are going to impact our statement of stockholders' equity. And if we add them together, the common stock, additional paid-in capital, and retained earnings, we get a total of $15,000. So that would be the ending balance on the statement of stockholders' equity. Okay, number 18 is next. This company began the year with a retained earnings balance of $45,000, net income of $80,000. Then the controller found that there was an error with depreciation, resulting in an understated depreciation expense of $2,000. Okay, so let's think this through. Starting retained earnings balance of $45,000 plus net income of $80,000 brings us up to $125,000. Then they found that there was actually more depreciation expense in the previous year, right? So more depreciation expense. Oh, I guess it's the same year we're talking about. Let's see. Yeah, I think it's the same year. Yeah. Because the whole thing is about last year. Okay. So $125,000 is the retained earnings balance plus the net income. But then we find out that we had an understated depreciation expense. Well, if our expenses go up, our profit goes down, right? So when we make that correction of the expense, our profits will go down by $2,000. So now instead of $125,000 of retained earnings, it goes down by $2,000 to $123,000. So that is our ending retained earnings balance. So it's 123,000 is the answer. And then just for reference, was 45K plus 80K, and then minus the $2,000 from correcting the expense error. Okay. Next, exercise 19, we're going to find out the weighted average shares. So this company, it says, had 600 shares of common stock at the beginning of the year. Okay, so they had 600 shares, and they had that for January, February, and March. So 3 out of the 12 months of the year. That's how many shares had been issued. Then for the next 9 months, they had another 500 shares that had been issued. So the original 600 plus 500 more gives us 1,100 shares, or 9/12 of the year. So what we're going to do now is we're going to average it out and see what was the average number of shares that had been issued throughout the year. So the way we do that is we take the first number, the 600, times 3 divided by 12, and we get 150. Okay, it's basically taking 600 shares for the year, but saying, well, it was only for the first 3 months of the year, so we're going to call it 150 shares. It was 1/4 of a year, so 1/4 the number of shares. And then we're going to take the 1,100 shares over 9/12 of the year. So we're going to take 1,100 times 9 divided by 12. And that's 825. Oops. 825. Okay. We add those together, and the number of shares issued averages out to 975, right? Because there were 600 at the beginning of the year, 1,100 for most of the year. When we average it out, it's somewhere in the middle. It comes out to 975. Why do we do this? Well, because if we're going to calculate earnings per share, which again is one of the favorite ratios of investors, stock investors, they want to know what were the earnings of the company divided by the average number of common shares outstanding. And that's what we just figured out. The average number of common shares of stock that were outstanding, or I'll also known as the weighted average shares. Okay. So now what we're going to do with the same company is we're going to calculate their earnings per share. So the first thing we do is figure out their earnings. It says they had a net income of $90,000. However, their earnings per share, as I mentioned, gets divided among the number of common shares of stock that are outstanding. So the EPS, or earnings per share metric, really is not looking at preferred stock at all. So what we're going to do is take the net income of the company and subtract any dividends that were paid to preferred stockholders. Okay, so it's the net income minus preferred dividends, and that equals $85,000. So those are the earnings we will use in earnings per share. So $85,000 will be the numerator in that equation. Then let's see, we're going to take the earnings. Oh, it's asking what is the earnings per share for the company rounded to the nearest dollar. So we're going to take the earnings of $85,000, divide that by the weighted average number of shares that we calculated back here, 975. And we get $87.18. So that is the earnings per share. It's the net income minus the preferred dividends divided by the weighted average number of common shares of stock outstanding. That is a mouthful to say. Let's double check my final number there. Number 21 is, oh yes, rounded to the nearest dollar. I had a feeling something was off. They did say to round it to the nearest dollar, so it'll just be $87, okay? So we're done with the exercise set. We have 4 problems, and they will not take us very long, so hang in there. We will be done shortly. Okay, chapter 14, and we're going to start with problem number 1. So problem number 1 says we are a CPA, a certified public accountant. We've been hired by some company to assist with their initial public offering. So the company is going to go from a privately held corporation to a publicly traded corporation, which is a lengthy and expensive process because you need to get listed on a stock exchange. You need to work with an investment bank to do that. You hope that investors are going to pay as much as you think your stock is worth. Facebook had an interesting experience when they did their IPO. The investors were not really thrilled, and the stock price immediately went down and stayed down for a while. Eventually, it recovered and it did really well. But for the first period of time, because Facebook did not have a clear profit strategy, a clear revenue model at the time, at least not according to the investors. And so their IPO was not what they wanted as a company. Because you want your stock market price, you want your stock market price, I should emphasize that differently, to be as high as possible, because then whenever you issue stock, you get more money, right? And their stock price went down. So anyways, so the question here is, what are the 5 steps in launching your initial public offering or IPO? And you can find that in the textbook if you go to chapter 14, go down to, what did I say there? 14.1, okay. So under chapter 14, there's section 14.1. And then you're going to have to scroll down in that section. Okay. Scroll down in 14.1 until you get to the section on marketing. It's about halfway down. Here we go. Marketing a company's stock. And here you have the 5 steps. You need to have a trusted management team to guide the company. You need a financial reporting system, of course. You need an investment banker to help you with the IPO process. You need to write the company's story to help convince investors why this is a good investment. And then you approach your investors. So I'm just going to copy those 5 steps and I'm going to put them here in my template. You are welcome to do the same so that you've got access to that information when you take the problem set quiz in Canvas. Okay? Or you can rephrase it in your own words if you'd like, because again, this is just for your reference. Next, we're going to problem number 6. This one deals with treasury stock. But the stock is getting resold, which is something we've not seen before. So let's go ahead and walk through it. Okay. So this company, let's see, they bought 1,000 shares of their own common stock at $11 per share. Okay, 1,000 shares times $11 is $11,000 worth of treasury stock, right? And that's how much they paid for it. Then on April 10th, they sold 500 shares of that treasury stock. So what we do is we take 500 shares times the original price they paid per share of $11. And we see that that's $5,500 worth of treasury stock. However, they sold it for $15 per share. Okay, well, they sold 500 shares at $15 each. They took in $7,500 of cash. Since the cost of that treasury stock was only $5,500, that leaves a difference of $2,000. That is additional paid-in capital from treasury stock. Then on June 12th, they sell the other 500 shares of common stock. So again, based on the initial price, that treasury stock cost them $5,500, right? So that's going off of their books. However, they sold 500 shares at $9 each. That's $4,500 of cash that they received. So they basically lost $1,000 on this treasury stock. And so that $1,000 is a debit to additional paid-in capital because it reduces how much paid-in capital we have received from investors, right? So normally the paid-in capital is coming from selling the stock for more than the par value or more than the treasury stock cost. And so it is a credit. But in this case, because we sold it for less than the cost of the treasury stock, it is a debit. Okay. Then we go to number 9. All right. Let's get this all on one page here. Yes, I remember this one. Okay. Okay, so this company, let's see, their stock, their preferred stock has a $100 par value and it's 8% cumulative. What that means is that if for one period of time they don't pay out the dividends to the preferred shareholders, in the next period they get double. They get the last period's dividends and this period's dividends. Okay, so those are called cumulative preferred rights. The company also has $6 par value common stock. It doesn't matter how many shares have been authorized, so we're just going to ignore that. But it does matter how many shares have been issued. So 50,000 common shares have been issued, 1,000 preferred shares have been issued. Okay. And on March 1st, the company declares a cash dividend. So that's $20,000 that they are going to be paying out. So that is a cash dividend payable. We have to figure out how much of that goes to preferred stock. So what we do is we say $100 par value, whoops, times, it was 1,000 preferred shares, times 8%. Okay, so it's the number of shares times the par value times the percentage. That's $8,000 of dividends that go to the preferred stockholders. However, remember that these are cumulative rights. And it says here that the company is 1 year in arrears in paying preferred dividends. So we have to double that $8,000 and pay for last year and this year. So that's a total of $16,000 in dividends that go to the preferred stockholders. The rest, $4,000 left over, goes to common stockholders. Okay. Then when the dividend gets paid out, $20,000 of cash dividends payable goes away. $20,000 of cash also goes away. And the last entry here is a 3-for-1 stock split. We haven't talked about stock splits, but basically what that is when, let's say you wanted to increase the price of your stock. What you would do is, if you've got some investors out there, let's say you've got an investor that owns 2 shares and the par value is $5. So together that's $10, right? 2 shares times $5 each equals $10. What you would do with the stock split is say, okay, now you only have 1 share worth $10. So you split the number of shares in half, but each share becomes worth twice as much. So it's the same overall value that each investor has. Why would you do that? Well, actually, I think what I just did is a reverse split. So sorry about that. A reverse split pushes up the price of the stock. A stock split actually, a normal stock split actually lowers the price of the stock. So in that case, you would go, in the original example I gave you, you have an investor has 2 shares worth $5 each. You would say, okay, now you have 4 shares, each worth $2.50. So again, it's still the same $10 worth of stock. They have twice as many shares with half the price, right? Why would you do that? You would do that if you wanted your stock price lower, because it will also impact the market price of the stock. And it would make it cheaper for people to buy your stock. And then you might be able to sell more stock because it's cheaper per share. On the other hand, if your stock price is too cheap, where people are looking at it like, what's wrong with your company? Your stock price is too low. I think, was it last week I used Lenovo as an example. We saw that their stock was trading at like $1.02 per share or something. You might want to then increase your stock price. That's where you would do the reverse split. Okay. So in this case, we're going to do a 3-for-1 stock split. So for the common stock. So there are 50,000 shares. Now there's no journal entry that's required for a stock split, but you would notate, you would put a note in the journal, but you don't actually do a financial transaction. So in that note, we might take the 50,000 shares, multiply it by 3. So every investor who has common stock is going to get 2 extra shares for every 1 share they already have, right? So they're going to triple the number of shares that they have. So there were 50,000 shares. We'll multiply by 3. There are now 150,000 shares. The stock price, the par value of the common stock was $6 per share. We're going to divide that by 3. And the new par value is going to be $2 per share. Okay, so in a stock split, you increase the number of shares, decrease the par value, both by the same number. So in this case, it was 3, but it could be 2, could be 4, doesn't matter. Depends how much of a change you want to make. Okay, so we multiplied the number of shares by 3, divided the par value by 3. And that's all we have to do for that. Okay, in the note, I mean, you might want to explain, what's going on, but this is how the calculation would look. And we are now up to our last problem, which is problem number 13. Yes, problem number 13. So you are going to need to do some research on this one, but let me just explain it. You're going to find 2 publicly traded companies in the same industry. Okay, so for example, could be Coke and Pepsi, could be Verizon and AT&T, could be, you get the idea, right? 2 companies, same industry. Then find the earnings per share. You could use the same resources for the course project, things like Yahoo Finance could be a good source to look up different company stock, and you'll find earnings per share oftentimes on the same page as the company stock. Let me just, as an example, let's just put, well, not Adidas, Nike stock. Even on this page, it might, it shows us the price earnings ratio, but it doesn't show us earnings per share. Oh, but what if we just put Nike earnings per share? 2023. Okay, so you might be able to find it like that. But if you do have to go to, let's say, Yahoo Finance, and go to whatever company, Nike, you'll notice right here it shows earnings per share is 3.47, right? It's right there. So do that for both companies that you picked. Remember, same industry, 2 companies, they have to be publicly traded corporations. And get there to earnings per share. So you could then go back to your problem set. And for example, Nike was 3.47, I think it was, and find another shoe company, I don't know, other shoe company, and put their earnings per share, whatever it is, okay? The comparison, well, you could say Nike had a higher EPS, you could say the percentage higher it was, or how many points higher, however you want to compare the 2. And then explain, would this difference influence your decision to invest in one company or the other? So you could say, yes, it would for such and such a reason. Earnings per share is important to me because I want a company that's making a lot of profit and doesn't have a lot of shares. Or you might say, no, it doesn't make a difference because I think that Nike is the greatest company in the world, and whatever their EPS is, I'm going to invest in them anyways, whatever. Okay, so it's up to you, but go ahead and solve that problem, or fill it in, and it'll prepare you for whatever questions are going to be on the problem set for problem number 13. Okay, the others, hopefully you'll be able to solve, but always let me know if you need any assistance or have any questions. And that is it. We are done with the problem set. All right, Maria, did you have any questions today?
No, probably have to go back and read again the chapter because I got kind of lost at the last
I see you unmuted.
problems.
Hear you.
Mm-hmm.
So if there are any questions, you can put them in the chat.
Okay.
If not, that's fine. And I'll see you next week. Okay. All right.
Okay, thank you. Bye-bye.